Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study how they actually think. Today we're examining an expert advisor called Damped Oscillator Regime Shift. It's a strategy built from physics rather than from a library of chart patterns. It treats price like a moving object governed by an equation of motion, and every single bar it measures whether the market is behaving like a spring that pulls price back, or like a trend that carries price away. Stick with me, and you'll see exactly how it makes that decision. Remember, this is educational content only. So what does this expert advisor really do? At its heart, it makes one unusual assumption. Instead of reading indicators or naming candlestick patterns, it models the logarithm of price as a one-dimensional mass moving under a damped oscillator. In plain terms, it describes how price accelerates as a combination of two things: how far price sits from its recent center, and how fast price is already moving. Those two influences are captured by two numbers the strategy calls A and B. Here's the key idea. The strategy does not choose A and B in advance. It measures them, fresh on every bar, using ordinary least squares over a window of recent motion samples. The default window is 50 bars. The first coefficient, A, is a position feedback term, a kind of stiffness. When A is negative, price is being pulled back toward its center, which is a stable, mean-reverting spring. When A is positive, displacement feeds on itself, and price runs away from center, which is a self-reinforcing, trending regime. The second coefficient, B, describes damping, and it's used as a conviction gate rather than as a signal on its own. Why frame it this way? Because the most damaging mistake a systematic approach can make is to apply a mean reversion rule inside a trend or a breakout rule inside a range. This strategy is structurally built to avoid that. The very same stretch away from center produces opposite trades depending on the sign of the measured stiffness, so the system is designed never to fight the regime it has just identified. Because everything is recomputed from raw price on every bar, the approach is adaptive by construction. There's no fixed indicator preset and no permanent directional bias. That makes it most interesting to systematic, quantitatively minded traders who enjoy understanding the mechanism, rather than to someone hunting for a fixed set-and-forget button. And, as always, trading carries real risk, and losses are a normal part of any strategy. Let's walk through the logic step by step. The expert advisor acts once per completed bar, so it waits for a candle to close before doing anything. When a new bar forms, it gathers the recent history and fits the equation of motion. Over the last window of samples, 50 by default, it solves for the two coefficients A and B using least squares. This is the measurement step, and it happens every bar. Next, the strategy calculates the standardized displacement, which it calls D. This is simply how far the newest price sits from its recent center, divided by the recent standard deviation. So D is expressed in standard deviation units, which lets one rule work across different symbols and volatility levels. Now the regime decision. The strategy checks the sign and size of A. It ignores weak, indecisive readings by requiring the absolute value of A to exceed the dead zone, which defaults to 0.02. If A is clearly negative, we are in a restoring regime, a spring, and the strategy fades the stretch. That means if displacement drops below the negative entry band, it signals a long, expecting the spring to pull price back up. If displacement rises above the positive entry band, it signals a short. The default entry band is one standard deviation. If instead A is clearly positive, we're in a trending, self-reinforcing regime, and the logic reverses. Now the strategy rides the stretch. Price running up and away signals a long, and price running down and away signals a short. Same displacement, opposite trade, decided purely by the measured stiffness. There's one more filter before any entry. The damping coefficient B acts as a conviction gate. If velocity feedback is strongly working against the intended direction, the trade is vetoed. This keeps the strategy out of dynamics that are actively suppressing the very move it wants to join. Risk management is dynamic. The stop-loss distance is the ATR multiplied by AtrSlMult, defaulting to 2 times ATR, and the take-profit distance is the ATR multiplied by AtrTpMult, defaulting to 3 times ATR. That gives a target-to-stop shape of 3 to 2. Once a position is open, the stop trails chandelier style, only ever tightening. And critically, if the fitted regime flips against an open trade, the strategy closes it immediately. The physics changing sign is itself an exit. Only one position per magic number is allowed at a time. Let's read the MQL5 as if we were sitting in Meta Editor. At the top are the inputs. Window is the number of motion samples used to fit the equation of motion, 50 by default. EntryBand is how far price must stretch from center in standard deviation units before an entry is armed. Dead zone is the minimum stiffness needed for the regime to count as decisive. ATR period, AtrSlMult, and AtrTpMult control the ATR-based stop and target distances. Now the decision block. The code computes two booleans. Restoring is true when A is below the negative dead zone, a mean-reverting spring. The self-reinforcing case is true when A is above the dead zone. Inside the restoring branch, if the standardized displacement D falls at or below minus the entry band, the signal is set to +1, along, because price is stretched below center and should be pulled up. If D rises to or above the entry band, the signal is -1, a short. In the trending branch, that mapping flips, so price running up and away arms a long and price running down and away arms a short. Now look at the two order blocks. For the long, price is read from the ask. The stop loss is placed below entry at AtrSlMult times ATR. The take profit sits above at AtrTpMult times ATR, and the trade dot by call submits it. For the short, price comes from the bid. The stop loss sits above entry. The take profit sits below, and trade dot sell submits it. Notice both sides are perfectly symmetric, and both size their stop and target from live volatility. Let's watch the strategy work through a full sequence on this illustrative chart. Running along the price, you'll see a blue line. That's the equilibrium center, the rolling mean the strategy treats as the resting point of the spring. Below the candles is the standardized displacement, our subpanel, showing how far price sits from that center in standard deviation units. There's an upper entry band at +1, a lower entry band at -1, and a center line at 0. Watch the first few candles. Price drifts gently lower and pulls away beneath the equilibrium center. In the subpanel, the gold displacement line slides down from near 0 toward the lower band. Each candle is stretching the spring a little further. On the fourth candle, price prints a fresh low, and the displacement pierces below -1 into the shaded region where price is meaningfully stretched below center. Now, in this stretch, the fitted stiffness A is negative, so the strategy has measured a restoring regime, a spring. That means it fades the stretch rather than chasing it. The buy entry marker appears right at that trough. The stop loss is placed a set multiple of ATR below the entry, and the take profit sits a larger multiple of ATR above, giving that 3-2 target to stop shape. From here, the story is the spring doing its job. The next candles recover, price climbs back toward the equilibrium center, and the displacement rises off the lower band back toward 0. As price reaches the take profit target above, the long is booked. That's the mean reverting leg complete. Now the market swings the other way. Price pushes up through the center and keeps going, printing higher closes. In the subpanel, the gold line climbs above 0 and heads for the upper band. On the ninth candle, price stretches well above center, and the displacement pushes past +1 into the upper shaded region. The measured stiffness is still negative here, still a restoring spring, so the strategy fades once more, this time to the downside. The sell entry marker appears near that peak. The stop loss now sits a set ATR multiple above the entry, and the take profit sits below. From there, price rolls back down toward the center exactly as the restoring regime implies. The following candles ease lower. The displacement falls back through 0 and toward the lower band, and price reaches the short take profit target below. The second trade is complete. Notice what tied both trades together. In each case, the trigger was price stretching beyond the entry band while the measured regime was a spring, and the exit was price returning to its target as displacement normalized. And remember the built-in safety valve we discussed. Had the fitted stiffness flipped sign against an open position, the strategy would have closed that trade at once, because a change in the physics is itself an exit. This is illustrative, of course. Real markets are noisier, regimes are not always this clean, and losing trades happen. But it shows how one adaptive rule can fade a stretch in one moment, and, when the measured regime flips, right a stretch in the next. So there we have it. Today we broke down the Damped Oscillator Regime Shift Expert Advisor. We saw how it models price as a mass on a spring, how it measures the two coefficients A and B every bar to identify the regime, and how the sign of that stiffness decides whether it fades a stretch or rides it. We also walked through the ATR-based stops and targets, the damping conviction gate, and the regime flip exit. Everything you've seen here is for educational purposes only, and none of it is financial advice or a recommendation to trade. Trading involves real risk, and losses do occur. If you found this breakdown useful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.